We start off with a major market turnaround. The Dow down 153 points at session lows before rebounding and rallying to close up 200 points on the day. The S&P 500 closing up more than 0.5%, and the Nasdaq surging 52 points, all as investors shake off the war in Israel following the deadly Hamas terror attacks over the weekend. Crude and Brent both popping more than 4%, both seeing their biggest gains since early April. Safe haven gold up more than 1.5%, and the defense sector posting an outsized move higher as expected. Airline travel-related names suffering today. Major carriers, including United, Delta, American, suspending service to Tel Aviv. The late-day rebound seeming to coincide with commentary coming from a number of Fed speakers. Our Steve Leisman will be along shortly with all of that. But we begin with the question, why are markets so calm in a seemingly world of a crisis at this point? Guy,
and this is a hard show. We got to be careful, obviously. We understand what's going on. We're respectful of that. But we're tasked to do something through the lens of the market. And Karen and I were talking before, and I think part of it is this belief that interest rates will now fall on the back potentially of the Fed, or maybe the market will do it itself in the form of some safe haven asset, which should theoretically be somewhat supportive of stocks, on top of which, that 4,200 level that we traded down to now a couple times has been a line in the sand that we've held. So, Tim talks about the setup of positioning. It's a big part of this without question. The real issue for the markets will be understanding everything that's going on. Now with this Fed rhetoric seemingly dovish, what happens if these numbers, these inflation numbers, are somewhat hot this week? That creates a bit of a problem.
CPI Thursday.
Before the horrors of the weekend, though, we had an intraday reversal on Friday that I think was more defining than any of this. And I think this was just a continuation. I think yields started to give ground. We reversed it today. It kind of felt like that CPI day back in October of 2022 when you had really strong data. In that case, it was inflation data that was kind of the highest print we ever saw, and therefore the lowest the market got, and rallied off that point. I feel like we had some of that. We're going to wait to talk about the Fed with Steve, but I feel like a market and an S&P that had sold off, almost 8% to the 200-day, almost as if it was supposed to. You then also have had this relative outperformance by the stocks that need to lead the market. So you have the 7, whatever we're calling them, that the triple Qs have dominated in. On Friday, they closed, at least for this move off that. This stage was set on Friday. The fact that yields had such a big move, Karen, the flight to quality, all the things that we're talking about mean that I actually think equities can trade higher. I mean, industrials, utilities, staples, all of these things had big, scary, kind of almost crescendoing, I think, at least temporary bottoms.
The bid for bonds certainly helps. I mean, we saw the bond market was closed today, obviously, in observance of Indigenous Peoples Day. But, through the TLT, through bond futures, we know that there was a bid, as expected, for bonds. And so yields would be lower. We would ease the pressure off of stocks.
Right. Although we have seen geopolitical events where there's the flight to quality and a flight away from equities. And we didn't see that. Right. Well, we saw it in the morning, but by the end of the day, we certainly didn't see that. I think, though, to your point, this could all go away if we see a really hot number, right? I think maybe the next meeting, okay, maybe that's not on the table, but certainly for one after, if there's I think we could reverse all this. From Friday morning, the market was looking down about 200 points. And so that rally from there through that giant rally Friday through this rally today, that's a pretty big reversal.
3%.
Yeah. And so I don't know. I feel like it's getting this mini bounce, I think, is near the end.
Yeah, I think, Tim's point about all those sectors that were down 10+%, and there were like 7 or 8 of them, right? And there was definitely, a flight to quality in some of the biggest tech names that had kind of kept the indices afloat a little bit. And we only got down 8.5% at its lows, the S&P 500. To Guy's point on the technicals, it got right to that 4,200 number. That was that rising 200-day moving average. So that was a big technical spot. And to your point, sentiment was bad, And so when you have an event like this, I think we were all glued to our TVs and reading about this all weekend long, and you say to yourself, this just doesn't feel great, right? And so, the good news is that we have, again, if you're looking at it through the lens of the market, as we're doing right here, we have earnings that are coming up. A Pepsi tomorrow morning before the opening, that stock was down at its lows yesterday, I think 20% or something from its all-time highs just a few months ago. I don't think the sentiment gets that much worse. You have a stock that was trading at 27 times, now at about 20 times next year's number, at about a market multiple. We haven't seen that sort of multiple compression in a stock like Pepsi in a very long time. All that being said, That could happen to Apple, too. I mean, like, it just happened to about 10 literally household names that we all took for granted, right, are staples, and they trade like that at that multiple for a reason. So I just say, as we get into earnings, let's see what the fundamentals say, because the geopolitical situation around the world is not going to get better. I think we could all put our little political science hats on and say, this emboldens Russia, this emboldens Iran, this emboldens China. Like, I mean, the list goes on. And all of that, to me, is inflationary. When you think about the move that we've had in the last few years to deglobalize, and then if you look at the disruption to supply chains from a war like we had in 2022, all inflationary. So rates don't have to go much higher at all. Fed funds futures are pricing less than a 15% chance at that November meeting of a hike, and that's down from 30 about a week and a half ago or something like that. But if growth really stagnates, then we are in a stagflationary environment, and that will not be good for corporate profits. And I know that S&P earnings have been down 4 consecutive quarters in a row. So we had the earnings recession. Let's see if the recession comes in the economy.